Hello everybody, welcome back. So let's have a look at Bitcoin. This is Bitcoin on the weekly. So kind of doing more or less what we expect, which is to have a move, whether it's even if it's just a dead cat bounce from this green 50 exponential moving average on the weekly, similar to how we've performed, whether it's a bull market or a bear market. We seem to always have a good reaction around this area. So this is your 2013 actually, not quite the end of the bull market, but a pretty horrendous. Pretty horrendous move down to touch it, 76% from the first time we actually touched it, and then a bounce, and then a retest, and then a bounce. This is the bubble pop, came down to test it, that was a 100% move, about a 60-70% move, and so on. Bull markets, we come down, test it, and bubble pop, tested it, 100% bounce. So, I mean, we go through it all the time, to be honest, we do go through it all the time. Now, there was a period in 2019, actually, where we went down below it a little bit, but you know, overall, and again, I use the analogy of it's like TA is like going to placing a bet at the bookies, yeah. So you might have good odds, but there's always a chance that Leeds United might win the Premier League, and they might do. Do you know what I mean? They might do, but they probably won't. The odds are against them, but they might win. So yeah, this is all that TA is. It's like going to the bookies, working out the odds, playing the odds to in your favour. So this is why I was saying that my opinion on Bitcoin right now is that this 33,000 area, whether it's a little below or a little above, a little below, a little above, no big deal. So long as we're closing weeklies above it, I'm not calling for any kind of bear market. If we do close weeklies below it, I would expect a further downside, potentially all the way down to 16,000 or wherever this 200 exponential is at the time. But because we've not closed a weekly below there, I'm still in favour of not just a decent bounce, but probably a continuation of a bull market throughout the rest of the year. Although my preference and my expectation is that we will range and range in quite a large area, in the area we've established already. But it could be as high as about 48,000, 49,000, being where the 20 weekly is. And back down to around 33. Now we can have wicks below there, just like we have already. We could have wicks down to 30,000 again, no problem. We could even come down to 29,000, 28, 29,000. I'm talking wicks, but provided we close our weekly candle bodies above 33,000, which is more or less where this 50 exponential moving averages, everything should be okay. So yeah, everything's up to date, and this is the time for the bulls to celebrate. But rejections can take place at a number of different places, and we'll have a look at this on the daily. So first of all, we've got the $38,000 zone, which is more or less being tested, and broken at this very moment. Yesterday we saw that we were rejected from it. The reason for that, clearly a rejection zone from back down here. It makes more sense to see it on the weekly. Weekly charts are a lot neater, to be honest with you, to see this. So we can see candle close, wick, close, launch pad, 38,000. And again, we did have a bit of a few moments on the daily when we were coming down at the 38,000 level. It's always been a bit of a problem recently. So breaking above there is good on a daily, definitely. On a weekly, even better. And you can see that finally we've started to close a candle above this 10 exponential moving average, which is good. This is what I would expect to see in an accumulation period. Sorry, that's my daughter. She's not feeling well. She's sitting in the back doing work on her tablet, which is YouTube work. not the same as my YouTube work. But yeah. So she's in the background. So just ignore the little voice there. She's not feeling too well. Right, so as I was saying, an accumulation period, an accumulation range will be more evident once these moving averages start to meld into one. Now, what we really want to see is an accumulation range take place above the 200 exponential moving average, that on the daily, which would stop any kind of death cross taking place. A death cross doesn't often play out in the dramatic way that people expect it to. It does, it can do. We can see in 2019 when we had you could call it a bubble pop, or at least our peak, we did come down and have a death cross here, but the move was largely already played out, and you could argue that this was already dumping. By the time we got the death cross, the candle was down here. If we measure it from the top of that candle where the death cross really was, we're only talking about a further 15%. So death crosses aren't the thing that people refer to as the end of the world. but they do offer furthermore downside. They're not signals. What they are is they're divergence in a negative respect. So it just makes it harder for you to break above them, and that's pretty much all it is. So don't expect a textbook 38% or whatever it says on Investopedia. Don't jump the gun and expect to see massive downside, because it doesn't always play out that way. We just saw that in 2019. So the move is largely already played out, and if there is further downside as a result of a death cross, it might be bad, it might not be so bad. Whatever it is not the death cross doing it. It's the chart formation, the integrity of the chart, just strengthening in its bearish posturing. It doesn't necessarily mean it's going to drop down to $5,000 or whatever it is. So, long story short, where we are at right now seems like an obvious area to be rejected from. It is the 20 moving average on the daily, the centre of the Bollinger Band. I would expect to see a rejection from there, but if for whatever reason we did break above there, we have every chance to get up to this 200 exponential, where I pretty much would expect to see a rejection, just as we did on this super bounce here. Big bounce, 2 days in a row, rejected from there. And again, this is going to prove to be one of the main areas to conquer, because it does negate the death cross. And I know I've just undermined the power of a death cross. But we don't want to have one all the same. We'd rather avoid it if we could. And so this is what I would expect to be the obvious place for a decent rejection. And maybe then we could accumulate at a higher range. Maybe it's between the 200 exponential and the centre of this Bollinger Band. Again, that would allow for these moving averages to start to snake up and meld into a bit more of a one area, all of them basically being in an area not offering any particular bias, whether it's up or down. Currently it's still technically down. The downtrend is still technically down, although it does look pretty good at the moment. This is still technically a downtrend, but there are clues now to suggest that this may have been the bottom, or if not, this is going to be the range that we will reaccumulate in for a longer period of time. If we can reclaim this centre of this Bollinger Band and this $38,000 zone, then the accumulation range would be at a higher area, between probably 38,000 and maybe around as much as, or as high as, about 49,000. So, oscillators down here look all pretty good so far. I mean, everything on this is relatively positive. It's not bullish, but it's not bearish either. It's showing signs of recovery. But remember, we are technically still in a downtrend, and we are at resistance right now. So, if we do get rejected from here, I still don't think it's the end of the world. It goes hand in hand with what I've been saying, I suppose, for the last week or two, which is essentially we're going to reaccumulate around this zone, which is a large zone, anywhere from as low as 28,000 to as high as maybe 49,000. Anyway, I'm going to leave it with you there, but thank you for watching. I hope you have a nice day. Take it easy.